In this episode of the FXTM educational series, we're going to be taking a look at fundamental analysis in the Forex, which can be a challenging topic, partially because oftentimes the way in which the fundamental factors are affecting an exchange rate or a trend are more about which direction investors think that the fundamentals are going to change in the future or in the near future versus what they actually are right now. But nonetheless, understanding the fundamental factors that play the greatest role in which direction the Forex is going or a particular currency pair is trending is going to be really important, especially as you evaluate the strength of the underlying trend. So let's look at a couple of examples of some of the key fundamental factors that you have to keep in mind. Now, the first one here is something we call interest rate parity. Now, interest rate parity refers to the difference between the government interest rates, so in other words, the yields on government bonds from one economy to the next. So oftentimes we summarize this basically as the target rate that the central bank will set, like the Fed funds overnight rate in the US, for instance. Now, if all else is equal, we would assume that the currency that is represented by the higher interest rate is going to appreciate in value against currencies with a lower interest rate until they reach a point of parity. Now, that is not always going to be true, but what it will do is it will help us to understand why there may be an emerging bias one direction or the other. So take, for example, from about 2012 through 2015, the target interest rate or that key interest rate in the UK was about 0.5%. Now, at the same time, the same interest rate or that benchmark interest rate in Japan was 0.1%. So let's take a look at a chart that represents this particular currency pair, the pound versus the yen, over that period of time. Now, as you can see, the pound to the yen, it did certainly trend in favor of the pound. There were likely many factors that were driving this at the time, but one of them was this interest rate differential. And this is something that has reoccurred at time after time. So this interest rate differential is one of the things that carry traders take advantage of in the foreign exchange, where they will essentially borrow at the cheaper rate with the cheaper currency. So in this case, for instance, they may borrow the yen and they will then subsequently buy the pound or pound denominated assets as a way to profit from that interest rate differential. Now, there is a little bit of a trick here in that we were talking about interest rates, but that's not necessarily addressing the real rate. So, for example, we always have to think about an interest rate, the real rate, as a function of what the nominal rate is, so what the yield actually is, minus inflation. So it is possible for an economy to have a very high target rate or key benchmark rate. Take Russia, for example. Through 2014, the key benchmark rate was about 11%, but inflation during that same period of time would actually exceed 11% from time to time. So it was also very high. Well, if we take their benchmark rate and we subtract that inflation rate, then we get the real interest rate and it kind of cancels that out. So it doesn't give them a significant interest rate advantage as far as explaining why the ruble should have been appreciating in value through 2014 and 2015. In fact, if we look at the real rate that's accounting for that inflation issue, well, that's going to do a lot to actually explain why the ruble had lost so much value against the dollar over that period of time, where investors were anticipating that the Federal Reserve was in fact going to start raising rates in the future. So if the real rate in both cases was actually quite a differential with an advantage, if you will, to the dollar, then it would explain a lot why the ruble fell so much over those 2 years. Now, the next two factors I think are somewhat related in the way that they modify the forces of supply and demand for a particular currency. So number one would just be growth in general. So, and if you think about it, economic growth, increasing demand for a particular currency should make sense. Think, for example, every time we see a lot of growth within emerging markets, well, one of the things that happens is that their currencies tend to appreciate, which can be a good thing in some respects and a bad thing in other respects, especially if it gets too out of hand. So we see that as growth, increasing the potential demand for a currency and therefore increasing its value relative to a currency that is connected to an economy that is not growing or even contracting potentially. And on a related note, we get commodity prices as well. Now, of course, commodity prices, if all else is equal, we would assume that commodity prices are probably going up with economic growth. So these are oftentimes something we would think of as being very connected or happening in tandem with each other. And commodity growth, now this is something that really affects the value of currencies that are associated with economies that are large commodity exporters. Now this can be a good thing, of course, when we have a lot of economic growth and commodity prices are going up. Well, that generally will give a significant advantage, if you will, to the bulls who are looking at a currency that falls into the category of a commodity currency. So let's say, for example, the Australian dollar, the Canadian dollar, those would be two classic examples. But it can also work against you. So for instance, starting at about the middle of 2014, so June, July 2014, oil prices really started to come down globally. So West Texas Intermediate prices, for example, came from about $104 per barrel to less than $40 per barrel during that period of time. So we would expect, again, if everything else is held equal, that probably indicates that economic growth is slowing down a little bit globally, and that commodity currencies, especially those who are very sensitive to the price of oil, should be devaluing against other currencies. So let's take a look at a good example here of the Canadian dollar. Now, as you can see, during that same period of time that I mentioned, the Canadian dollar dropped from about 1.05953, so shown here on my chart, to about 1.34562. Now, that's about September 29th, 2015 that it bottomed out. So this was essentially a loss of about 2,900 pips. I'm doing a little rounding here. Or in other words, it became 27% weaker against the dollar. So that is a significant decline. And it wasn't just the Canadian dollar during that period of time. The declining price of oil and commodity prices had a very similar impact on the Australian dollar, the Swedish krone, the South African rand, the ruble, the Mexican peso, and the Brazilian real. So this is not just isolated to Canada, but because the Canadian dollar is one of the majors, I think it's a good example for us to see this in an exchange rate where we would expect that the impact would be fairly large. Now, we've spent a lot more time talking about some specific ideas around trading commodity prices in another video here in the series. Now, just like stock investors are very interested in the quarterly profit reports that are released by public companies, Forex investors were all very interested in economic reports that are released within the economies that we're trading. Now, some of these are more important than others, but generally there's an underlying theme here that we can understand. Well, what's the impact of that news going to be on a particular currency? So, for example, we can generally assume that most of the time, higher numbers in these economic factors or these economic reports is probably going to contribute to a higher value in that currency that we're trading. So if, for example, GDP goes up, then we would normally assume that that's probably going to increase the value of the currency because that means that growth is increasing. It could also indicate that a rate increase is on the horizon and so forth. So we would generally assume that changes in GDP are going to be positively correlated with the value of a particular currency. The same thing goes for labor, in that if more jobs are being added to an economy, well, that does tend to drive inflation, which in turn tends to drive interest rates, which then in turn, according to interest rate parity, will have provide some underlying support or a positive impact on the value of that currency. Now, interest rates also, we generally assume that for very similar reasons that interest rates are going to have a positive correlation. So in other words, if an economy is threatening to raise rates, all else being equal, again, we'll probably assume that their currency will appreciate in value as well. Manufacturing activity tends to also have a very positive correlation with your currency's value. And if you think about it, that should make sense, because if you're manufacturing a lot, then it probably means your exports are going to go up. That means that the products that you're manufacturing are going to have to be purchased in your domestic currency. So foreign currency is going to have to be exchanged for that as to facilitate those exports. So it drives the value of your currency higher. Now, commodity prices can be a little mixed. If you're a commodity exporting economy, then we would expect that the relationship with commodity prices should be positively correlated with your currency's value. However, if you're a commodity importer, then this could actually have a negative impact. So it could have a negative correlation with your currency. So take, for example, the difference that we will oftentimes observe between the way that the Canadian dollar responds to higher oil prices versus the Japanese yen, how that may be sensitive to higher oil prices because they're a net commodity importer. Now, finally, inflation can be a little bit more challenging. All else being equal, if you have inflation, it's very common that you also have economic growth. And if economic growth is greater than inflation, and if interest rates are going up as well, then we would normally expect that that's probably going to have a positive level of correlation with the value of your currency. But that's a lot of qualifiers there. That's not always going to be true. So sometimes we get an inflation report where inflation is going up and growth is not within that economy. That tends to have a very negative impact on a currency. And in fact, smaller economies, that can have a significant destabilizing effect on their currency's value that becomes a problem. So in most cases, we would generally assume that these economic factors, and this is not fully comprehensive, but these are the major factors that I would suggest are the reports that we want to watch on a monthly basis. We would normally expect that they have generally a positive correlation with the currency rate that we're watching. However, there are exceptions to that. We just have to think through that as to, in the case of commodity prices, are they a commodity importer or exporter? And in the case of inflation, is that inflation occurring with increases in interest rates and growth or without? Now, the last two fundamental factors that we're going to talk about are important, but they're very difficult, if not virtually impossible for us to be able to predict. But we need to think about how do they affect currencies and currency values so we can understand the impact that they might have on the stability and the strength of the underlying trend of the currency pair that you're trading. So the first one of these is geopolitical risks. So this would obviously include war or the threat of war or other issues, so civil unrest as well. So take, for example, in 2011, the Arab Spring. Now, at the time, this has a negative impact not only on domestic currencies, where the unrest or the threat of war, in some cases, where that is happening, but it also tends to have a bit of a dampening effect on a lot of other currencies as well. Now, some currencies will act as a safe haven against those kinds of risks. Now, this is not always going to be true, but traditionally, the major reserve currencies and the Swiss franc tend to actually benefit in times where we're experiencing geopolitical risks. So as I mentioned with the Arab Spring in 2011, if we look at the euro to the Swiss franc, it actually fell from a level of about 1.3 francs to the euro to almost parity before the Swiss National Bank had to actually step in and peg the value of the franc to the euro at the time, which was quite extraordinary. The other fundamental factor that we have to keep our eye on is, of course, financial crises. So we had one of these in 2008, for example, and the response that you get in the Forex may be somewhat counterintuitive, actually. So during extreme financial crises, so the liquidity freeze in 2008, for instance, even though that basically started and spread from the United States, the reserve currencies, the major reserve currencies again, do tend to be the ones that benefit from that sort of risk environment. So during that time, from 2008 on, the dollar against a basket of other currencies until things started to cool off a little bit, the dollar itself, if we look at it just as an index, so against a weighted basket of other currencies in the futures market, it actually improved in value by about 25%, despite the fact that there were banks and insurance companies and mortgage companies and so forth that were all going out of business at the time in the US. But because that crisis was spreading around the world, investors were flocking to the safe haven reserve currencies. So in conditions like this, what we need to understand is not whether or not we can predict something like this, but rather, can we understand it when it's happening so that we can try to adapt or change to accommodate the effect that it will have in our portfolio.